As of this moment, on Sunday, December 7th, 2025, the market is closed, with Super Micro Computer Inc., ticker symbol SMCI, holding a last traded price of $34.23. The after-hours movement has been negligible, hovering in a tight range that suggests the market is holding its breath, waiting for the next shoe to drop. This figure, $34.23, represents a staggering collapse from the dizzying heights this stock once occupied just 18 months ago, creating one of the most polarizing setups in the entire semiconductor space. The expectation for Supermicro Computer was nothing short of dominance. The narrative sold to investors was that this company was the silent engine behind the artificial intelligence boom, the primary builder of the physical infrastructure that would house Nvidia's chips and power the next generation of computing. Investors believed they were buying into a mini-Nvidia at a discount, a company that would ride the coattails of the AI capital expenditure cycle to a valuation in the hundreds of billions. The reality, however, has been a brutal lesson in corporate governance and volatility. The reality is that while the technology, specifically their liquid cooling prowess, is undeniably top tier, the corporate structure and financial reporting have crumbled under scrutiny, leaving shareholders navigating a minefield of auditor resignations, missed filing deadlines, and a crisis of confidence that has slashed the stock price by nearly 80% from its all-time highs. This disconnect between the engineering brilliance of the company and the fragility of its administrative backbone creates the tension we are seeing right now on the charts. Investors are asking if this $34 level is the bargain of the decade or a value trap waiting to fall further. To understand why SMCI is trading at $34.23 and not $120, we have to look closely at the chaos of the last few months, specifically the November Massacre of 2025. November was a month that will likely be studied in finance classes for years to come. While the broader markets and stable giants like Apple stock and even volatile names like Tesla stock managed to hold their ground or advance, Supermicro Computer faced a distinct selling pressure that saw it drop approximately 35% in a single month. This wasn't just general market malaise, this was a targeted repricing of risk. The catalyst was a combination of disappointing first-quarter results for fiscal 2025 and the lingering hangover from the auditor drama that began back in late 2024. When Ernst Young resigned as the company's auditor in October 2024, citing that they were unwilling to be associated with the financial statements, it sent a shockwave through the institutional ownership base that the company is still trying to recover from today. Institutional investors, the kind who manage billions in Fidelity mutual funds or Schwab Intelligent portfolios, hate uncertainty more than they hate losses. When an auditor walks away, the sell first, ask questions later algorithm kicks in, and we are still seeing the tail end of that liquidation cycle. The price action we are witnessing now around the mid-30s is a battleground. Technically, the stock is trying to find a floor. It has bounced off the low 30s multiple times in the last few weeks, indicating that there is a layer of value buyers, perhaps retail traders using the Robinhood app or aggressive contrarians, who believe the company's actual revenue generation is too strong to ignore. These buyers are looking at the price-to-earnings ratio, which has compressed significantly, and seeing a disconnect. If you look at the fundamentals purely from a sales perspective, Supermicro is still shipping thousands of racks. The demand for liquid-cooled server racks hasn't disappeared. In fact, as chips from Nvidia and AMD get hotter and more power-hungry, the physics of data centers demands the exact solution Supermicro provides. The tension lies in whether the market can trust the numbers reporting those sales. When you log into your brokerage account, whether it is SoFi Invest or Interactive Brokers, and you see a PE ratio that looks incredibly low compared to peers, you have to ask yourself if that cheapness is a gift or a warning label. In SMCI's case, the market has priced in a governance discount, essentially penalizing the stock price because investors simply do not trust the boardroom. The narrative took another twist earlier this year when the company faced the threat of delisting from the Nasdaq. The deadlines in February 2025 came and went with high drama, and while the company remains listed, the scars of that period are fresh. Every time the company announces a delay in a filing or a change in financial leadership, the stock twitches violently. This sensitivity to news makes it a favorite for day traders on platforms like Webull or the active trading side of Fidelity, but a nightmare for the passive buy-and-hold investor who just wants steady compounding. The volatility has been so extreme that options premiums have remained sky-high, reflecting the market's expectation that the next 10% move could happen in either direction at any moment. It is crucial to talk about the business itself because amidst all this accounting noise, there is a real factory churning out real products. Supermicro Computer is not a vaporware company. They build the physical Lego blocks of the internet. Their building block solutions architecture allows them to customize servers faster than almost anyone in the industry. While competitors like Dell and HPE are formidable and have significantly better relationships with the street regarding transparency, Supermicro has historically been faster to market. When Nvidia releases a new H100 or Blackwell chip, Supermicro often has a certified system ready to ship before the ink is dry on the press release. This speed is their competitive moat. Furthermore, their bet on liquid cooling was prescient. Traditional air cooling, fans blowing air over hot chips, is reaching its physical limit. You simply cannot cool a modern AI data center efficiently with air alone anymore. The electricity costs are too high. Supermicro's direct liquid cooling technology claims to reduce energy costs for data centers by up to 40%. In an era where green computing and energy efficiency are paramount, this should be a massive tailwind. The tragedy of the stock's performance is that this incredible engineering story has completely been overshadowed by the accounting clouds. Let's pause for a second and get a pulse check from you. Comment below specifically on your average entry price if you hold SMCI. Are you holding a bag from the 80s or 90s, or did you manage to snipe an entry in the 30s recently? Also, do you trust the current management team to right the ship, or do you think a CEO change is necessary for this stock to recover? I read every comment to gauge the real sentiment out there. Analyzing the institutional activity provides another layer of insight. Throughout late 2024 and 2025, we saw a rotation. The smart money, the endowments and pension funds largely reduced their exposure. You can see this in the 13F filings. However, there has been a curious uptick in activity from quantitative funds and high-frequency trading shops. These entities don't care about long-term governance. They care about liquidity and volatility. They are trading the range. This changes the character of the stock. It moves less on fundamental shifts in the server market and more on technical levels and momentum flows. If you are trading this on Interactive Brokers or using the charts on E-Trade, you need to be aware that the algorithms are driving the bus. Right now, the stock is essentially pinned between the bears who think a restatement of earnings is coming that will wipe out equity, and the bulls who think the worst is priced in and the company is a takeover target. Speaking of takeover targets, that's the whisper theory that keeps some investors hanging on. The logic is that if the stock price stays depressed for too long, a larger player or a private equity firm might step in, take the company private, clean up the accounting mess, and then relist it or integrate it. The assets, the factories in Silicon Valley and Taiwan, the patent portfolio, the customer list, are worth much more than the current market cap implies, assuming the debt load is manageable. However, betting on a buyout is risky. It's a binary outcome. If it doesn't happen, you're left holding a stock that is largely shunned by the conservative wealth management divisions of major banks. You rarely hear a financial advisor at Merrill Lynch or Fidelity Wealth Management pounding the table to buy SMCI right now. The reputational risk is too high for them to recommend it to retirees. We must also consider the competitive landscape, which has shifted. While Supermicro was distracted with its internal controls and fighting for its listing life, Dell Technologies has been aggressive. Dell has launched its own liquid-cooled racks and has been leveraging its massive supply chain dominance to win deals with Tier 2 cloud providers and enterprise clients. Dell is the safe pair of hands. If you're a CIO of a Fortune 500 company, are you going to order $50 million of servers from the company that just lost its auditor, or are you going to order from Dell? That is the sales friction SMCI faces. Every day the headline risk